Hello class, this is a little screencast to help you in forecasting for your IBC company. Everybody that does forecasting, they always ask the question, is it an art or a science? Well, we will explain that question or answer that question when we get to the end of this presentation. There's a couple principles you need to be aware of in forecasting. There are different types of forecasting models that can be used in industry, and some vary in complexity and approach. But in general, there's a couple of principles that kind of apply to all models. First of all, forecasts are rarely perfect. In fact, most forecasts are not perfect 100% of the time. They may get it right a couple times, but there's always a type of error rate or variance with any forecast, and it's important that you actually track the error rate with the different forecasts so that you can help validate the different forecasting models and which one's more accurate than the other. The second principle is that forecasts are more accurate for shorter time periods than for longer time periods. The longer out that you are forecasting, the more variance and volatility that you will experience. And the third principle is that the forecasts are generally more accurate for grouped data. What that means is that when you have a lot of data that's kind of grouping together, you're a little bit more accurate with that than for individual items. Because individual items, you can have positive and negative variances that as a group would actually cancel out, but you get a little bit more variance with individual items. So those are just three basic principles of forecasting. Now, as far as the different methods, there's actually kind of two general approaches to forecasting. First is what they call qualitative methods. Now, qualitative methods are based on judgments, they're based on assumptions, some people even call them just educated guesses. You're basically forecasting on things that you think will happen based on your opinion. Versus the quantitative methods. Quantitative methods are based on mathematical models. You've heard of regression analysis, trend. Regression analysis and trends are forecasts that are generated through mathematical models, and they tend to look at the historical. Actually, trend analysis looks at the historical, and regression looks at the historical, but it also looks at the correlation, because you have historical data, which you say, okay, over time we're going to grow 5% a year. That would be historical data. But if you want to look at causal data, this is causal, such as what's causing an increase in sales. You may look at, the example they always use is like weather. As the weather as more snow falls, you will sell more snow shovels. So if you're trying to forecast how many snow shovels you're going to sell, you would use the amount or the rate of snow that is falling to help you forecast the amount of snow shovels that you'd sell. And then the third method is kind of a combination of both. You use both the quantitative, mathematical, which is the science part, and the qualitative, which is the art part. It's based on what you feel or what you think. It's subjective, and this is more objective based on math. Now, within any model, forecasting model, it's all based on assumptions, assumptions, assumptions. All forecasts require a multitude of assumptions, and the assumptions need to be validated. You need to have them be on some type of comparable data, and assumptions should be reasonable. So, for example, I'm going to give you kind of an IBC example. Suppose you're selling sandwiches in the Kimball Cafe. Could you sell $1,000 of sandwiches in one day at the Kimball Cafe between 11 a.m. and 1 p.m.? Well, you'd have to analyze that assumption. So if you were going to assume that you sell $1,000 over those 2 hours, that would mean you'd sell $500. Or if you're going to sell the sandwiches for $5 each, that would be a total of 100 sandwiches per hour. If you were to do the math, you'd have to sell at $5 each, 200 sandwiches to make thousands. You'd have to sell 100 sandwiches per hour. Now, can that be done? Can you crank out a sandwich every 36 seconds for 2 hours straight? Probably not. So that wouldn't be a valid assumption if you were to forecast that amount of sales. One way to validate some of those assumptions would be go do some observations. Go down to Subway and observe Subway sandwiches. How many sandwiches do they eat? And observe them for 15 minutes. How many sandwiches do they sell at lunchtime over a 15-minute period? Or go to the Kimball Cafe. If you say that in order to sell $1,000 worth of sandwiches, we have to sell to 200 sandwiches, I don't even know if there's 200 people walking through the Kimball Cafe during those hours. And so it's just things like that that you observe and validate your data in order, or record your data in order to validate your assumptions. Now, forecasting for a startup requires a lot more work than for an existing business. If you have an existing business, you have some historical data that you can base it off of, and you can do run rates and trend analysis to improve your forecast. But for a startup, you have to do a lot more planning, a lot more observations, a lot more testing, record your data, then outline your assumptions to see if they're valid. So it's important that you validate your assumptions in order to get an accurate forecast. Now let's look at this Excel spreadsheet, and in this scenario, we've got 1 year's worth of data. So I've got an income statement over here. We had sales of 800, cost of goods sold of 500, which gives us a gross profit of 300. Then I've got some marketing expenses, depreciation, profit before taxes of 200, and I've got about 25% tax rate, net income. And I also have my balance sheet over here. It looks like it's a beginning balance sheet. This IBC company probably borrowed $1,000 to start out with. They bought some inventory. They've got some equipment they depreciated for the year, and their retained earnings actually equals the net income from the year. So it's kind of 1 year's worth of data. The easiest way to approach forecasting is to start with something you're most familiar with and that has the most variation, which is sales. So if you were to forecast sales for the next year, if you think sales is going to go up by 5%, you know, the question first of all would be, why is it going to go up by 5%? That's where you need to outline your assumptions. You know, I've got a 5% growth rate due to new marketing initiative or something like that. A marketing plan, flyers, whatever, you know, whatever reason. You need to validate that growth rate. But it's based on an assumption. You're assuming that because of this new marketing plan, you will grow by 5%. Let's go ahead. Yeah, we'll just leave it at 5%. Now, cost of goods sold. Does that mean our cost of goods sold also goes up by 5%? This is where you have to actually analyze your company and how it works. For most companies, your variable costs don't fluctuate with the amount that you sell. And so I would assume that the cost of goods sold, the best way to approach this is I look at the percentage. I look at my cost of goods sold right now as a percentage of sales is 63% of sales, 62.5% of sales in the prior year, and I don't see any reason for that to change. So I'm going to take that percentage times my new sales number, and just change this to a dollar sign to come up with my new cost of goods sold. Gross profit's going to remain the same. Marketing expenses, maybe because of this new marketing initiative, I know the marketing expenses are going to grow more than 5%. It's going to cost me an extra, you know, last year was $75. This year I'm going to spend $100 on marketing expenses. Depreciation doesn't change because you have to look at it individually by each line item. I'm not buying any new equipment, so I know my depreciation for the year will be the same. And then my profit is now 190. Pretty interesting. My profit actually went down. You know, based on this marketing initiative, it actually went down. Taxes would be 25% of that. Oops, if I can type right. And then my net income is actually lower than the prior year. Okay, so maybe that marketing initiative is something I shouldn't do. Or maybe after I reanalyze it, we talk to the marketing guys, they say, oh, no, because of the marketing initiative, we're going to grow by 20% next year. And I can type that in, and I can see, okay, so we would have higher net income, and you have to look at it line by line, because each line will have a different assumption built into it. Most people start with the income statement first, then you roll right over to the balance sheet. Now, a given will be that my retained earnings is going to be what it was in the prior year plus the net income for this year, so I know that. Plus I know my note payable, I'm not going to pay it off, so I'm going to still have the same note payable amount. So now I know my total liabilities and equity. Now, as far as equipment goes, did I buy any new equipment? No. Do I have additional accumulated depreciation? Yes. Inventory. And so now we get into the trickier ones, inventory. This is where I have to make an assumption. Do I assume that my inventory will grow with my run rate? And you can look at different measurements, different metrics like days of inventory outstanding, your inventory turnover, and you have to decide what kind of business you're running. Maybe if you're running a business that's selling wooden watches, you buy inventory at the beginning and you're just going to keep selling until you sell out of watches. You won't increase your inventory. Or if you're selling some type of food product, you're going to buy inventory constantly. So I'm going to assume that I'm going to buy some type of food product and my inventory is going to grow with the same growth rate as my cost of goods sold. I got to look at the math on this because that is not looking right to me. But maybe it is. Yeah, I guess it's... Oh, yeah, that's right, because I grew by 20%. Sorry, I was thinking that it was a growth rate still of 5%. Okay, so maybe my inventory, in order to have that many more sales, if I want to keep the same inventory turns, maybe I'm going to assume that my inventory is also going to grow by 20%. Or maybe I'm going to be more efficient. That's where you have to build in your assumptions into the inventory. And then what I usually do is your cash is going to be your plug number. That's probably the easiest way to approach it. And so I know that my cash number is going to be 976. Now my assets equals my liabilities. I have now forecasted my income statement. I forecasted and rolled forward a balance sheet. Now if I had accounts receivable, I could also forecast that based on a percentage of sales. But you have to build in those assumptions. You have to validate them and somehow gather data to prove that it's correct, and then document those assumptions as you go forward. So hopefully that's helpful. Good luck as you start forecasting for your IBC businesses. And hopefully you'll have your forecasts prepared for the loan committee presentations. Thanks.